And this is Bloomberg Technology. Coming up in the next hour, the bulls' love affair with tech is being put to the test. Has the industry officially overheated? We will break it all down. And the rush to get out of U.S. tech stocks after Facebook results, with almost $300 billion getting wiped from market cap since. But investor Gary Vaynerchuk is buying. He tells us why he's still a big believer in Mark Zuckerberg. Ahead. Plus, the earnings still rolling in, with Apple and Tesla both on deck this week. What to look for when Apple reports to Tuesday. But first, to our top story. Monday opened with a big dip in tech trading. Despite the fact that Apple and Amazon continue to edge toward $1 trillion, investors have a case of the jitters. Billions have been wiped off the market caps of Facebook, Twitter, Netflix, Intel, and more on the back of disappointing earnings results. And Amazon is barely holding on to its gains. We are still awaiting Apple results Tuesday, Tesla on Wednesday. But will any sign of weakness kick off another downward spiral? To discuss, we're joined by Bloomberg's Romaine Bostick in New York, and joining us from London, we have Bloomberg's Caroline Hyde. So, Romaine, is this a short-term blip, or is this the beginning of a longer-term pullback?
Well, it's starting to look like it could be the start of a longer-term pullback. I mean, look, when you have Amazon and Alphabet report the kind of earnings that they did, which were great, and you still see the broader tech space get sold off in the way that it has, you have to be a little bit concerned. When you look at what happened last week, look at the rotation out of a lot of the tech names into some of the other sectors. When you consider the fact that what Facebook did and the way it sort of spooked the market, you go back to Netflix a couple of weeks ago, and the same thing. This is a group of investors right now who have ridden this rocket so high and so far that a lot of folks are concerned that they don't want to be left holding the bag should this sort of be the end, or at least the peak of this cycle.
There are a lot of Facebook debaters out there. Take a listen to this earlier from Calvert Investment President John Sturr.
Facebook is very, very dependent on its ability to expose a large number of users to all sorts of inputs, conduct this really large-scale psychological experiment, and sell that information to advertisers. That's what's really coming under pressure, and Facebook doesn't have a lot of other options.
These debates, Caroline, I know have spread all the way to Europe. Is this a global sell-off? I mean, are we seeing pushback like this in other markets?
We are. I mean, I'm just looking at what happened to the technology sector in Europe today. Broad brush down across the spectrum. We're seeing about 7 billion euros wiped off of that particular sector in Europe. You're seeing about $34 billion worth wiped off of the Asia index when it comes to the industry group of technology. So this is across the spectrum. It's not just perhaps, this chip makers. It's more broad than that. You're looking at SAP, a company that provides software to businesses. We're seeing other software companies such as Software AG in Germany on the downside. In fact, only about 5 or 6 stocks in Europe in the tech sector were in the green today. So when you see this broad brush selling that you're getting in the United States, when you see it maybe it being a cyclical change of events, when you've got Bank of America, Merrill Lynch saying, short the sector, this does have spill-on effects across different regions.
So here's the question, Romaine. Where will the money flow instead?
Well, right now what you're seeing it flow into is actually the sort of traditional industrial names. Last week, I mean, if you think about what happened last week, the best performing sector overall was the Dow Transportation Index. It was up about 2%, versus the declines that we saw in the rest of the market, in particular in tech. This is what you're seeing repeated right now. A lot of folks are going into the industrial names, the transportation names, some of the energy names, and some of the industrial names. This is where a lot of folks see safety. This is where a lot of folks, quite frankly, see value, and where they see some sort of growth that may be a little bit better than what they think is going to happen for some of the tech names going forward.
Now, Caroline, you mentioned the call to short tech stocks. Where in particular?
I mean, the FANGs, but when I say FANGs, I don't just mean Facebook, Amazon, Netflix, Google, which of course parent company is Alphabet. I'm also talking about the elongated FANGs. I'm including Apple as well. This is notable ahead of their numbers out tomorrow. So I'm looking at the moment at a particular chart that shows how much already has been eroded from that group. We've got about $250 billion worth knocked off their market cap so far since the Facebook debacle in terms of their second quarter figures. This is on GTV. But I'm also noting that Bank of America Merrill Lynch, led by analysts, is saying, look, this hammering of Facebook in particular was a sign of a peaking market. They call them cult stocks overall. This is a classic late stage event, according to them. So really, when you see monetary tightening start to be debated, when you see slower growth, we're starting to see a movement out of these momentum stocks. And as Romain has been talking so eloquently about getting into the safer sectors, getting into travel, and actually interesting call coming from Bank of America saying, hey, get into emerging markets as well when you've got some dollar weakness going on. But overall, this is really, though, on the flip side, going to have some naysayers. And of course, there's always two sides of the market. That's exactly what we always see. And so when you've got the likes of a strategist over at Oppenheimer saying, actually, maybe this is a buying opportunity. They're saying this likely presents more opportunity to buy the dips than to overall run for the hills. The question is how long they're going to run for the hills for.
I spoke to investor Gary Vaynerchuk earlier, who just bought $200,000 worth of Facebook stock. So he's a buyer. We're going to talk to him later in the show. Hear that interview. Romain, tech is very diverse. You know, Apple and Tesla are very different companies. What are the value plays still in technology that may be considered a safer bet at this point?
Yeah, well, there's been a lot of debate about sort of a rotation into value stocks. But the interesting thing about it is within the tech space, there are a lot of value names. I mean, if you look at the sort of the Vanguard Value ETF, its number one holding is Microsoft. When you consider Apple, keep in mind that its largest shareholder, or one of its largest shareholders, is, of course, one of the biggest value investors of all time, Warren Buffett. There are other names in there, including some of the names like Cisco and Intel, that when you look at on a price to earnings basis, price to book basis, and some of the other price to cash flow and other sort of metrics, they all sort of fall into the category of value plays. And we are seeing some analysts sort of single out some of those stocks going forward as being maybe where you want to be, getting away from some of the pure growth names that was Netflix and getting into some of these more what they consider to be value stocks. And you are seeing a little bit of strength there. If you factor out you know, some of the worst of the selling that we've seen, you'll see that names like Microsoft, like Alphabet, have actually held up pretty well, even given some of the downturn that we've seen in the broader tech space.
Facebook put a lot of the blame on its results, Caroline, on GDPR. What are people in Europe saying about whether or not GDPR and European privacy laws really are to blame, and whether or not we'll see similar fallout with other tech companies?
Well, I think thus far, I mean, the proof has been that Facebook perhaps have been hammered, but, you know, GDPR has been affecting the likes of Alphabet as well, and it's been a boon to their business rather than, you know, they went to Alphabet's Google because they didn't trust that the rest of some of the other advertising areas to be able to ensure that you're targeting the right user base are actually GDPR compliant, are compliant with these stricter privacy laws. And Facebook and Google were both meant to benefit for that reason, and it seems as though only Google did. Really, Facebook fell out of favor because of this was the first real telltale quarter of whether or not it affected users' desire to be on the platform, to be exposed to targeted advertising. In Europe, you're now unable to opt out of using Facebook once you see the new privacy rules, and they lost 1 million users overall. It's still a drop in the ocean compared to how many users they have across the board, but still, people from Europe, there's cynicism about whether really GDPR was what hurt their numbers, and whether actually it was more the PR effect of potential manipulation of developed country elections through the use of Facebook, and Russia potentially infiltrating the platform. All of this, of course, the seismic shift that was Cambridge Analytica as well, that really was felt in this previous quarter. But it's notable that Facebook wasn't the only one that blamed GDPR on loss of numbers, so too did Twitter. So there are some cynics out there saying, look, Facebook, that's an easy way of trying to find an excuse. We don't think it's actually the laws, we think it's actually more your PR effect, but they're not the only one claiming it.
Spotify also mentioned GDPR and their results. Romain, Apple out Tuesday, Tesla on Wednesday. What are you going to be watching
Well, Apple, of course, will be the most important, I think, just because folks really want to see how much basically that Tim Cook has been able to drive services revenue to make up a bigger portion of sales. Of course, it's about 15% of sales now. It was less than 10% of sales just about 6 or 7 quarters ago. So they've made a lot of progress there. We know iPhone sales growth is going to be relatively slow. I believe the consensus is around 2% growth for iPhone sales. So I think if you really want to get a clear picture of what this company is going to be, the services revenue is really where you want to pay attention to. As far as Tesla, that's probably going to be the most exciting, I think, just given what happened last quarter and given all the sort of circumstances surrounding Elon Musk's ability to not just generate profits, but really to get these cars off the production line and into the hands of all of the customers who have already handed over their deposits.
Bloomberg's Romaine Bostick in New York, Caroline Hyde for us in London. Thank you both. Lots more to cover this week. Meantime, here in the United States, Facebook continues to grapple with how they handle hate speech while not infringing on freedom of speech. And one investor believes it's not Facebook's fault when people spout intolerance on the social network. Take a listen.
I think this is one of the great examples in human time of us not interested in accountability. Facebook didn't make you a racist. You made yourself a racist.
You'll hear our entire conversation with Gary Vaynerchuk on Facebook, Apple, Amazon, and much, much more coming up later in the show. Up next, we're going to hear from Galaxy Digital founder and CEO Mike Novogratz about the prospects for his crypto merchant bank ahead of its trading debut in Canada. And if you like Bloomberg News, check us out on the radio. Listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Cryptocurrency merchant bank Galaxy Digital will start trading Wednesday on Toronto's TSX Venture Exchange. It could be a milestone moment for the industry and for the company's founder, Mike Novogratz. The former Goldman Sachs partner discussed how investors should view the business when he spoke exclusively with Bloomberg's Eric Schatzker on BNN Bloomberg in Toronto.
I think it 100% will trade at a multiple because you have a book of 45 different investments that people don't have access to start with. You know, the normal equity investor can't get access to the portfolio we have. But you also have 3 other businesses that are generating revenue and that are going to be very profitable.
All generating revenue already?
They're generating revenue. They're not profitable, all of them yet, but they will all be profitable very soon. And so you'll have, you know, and in some time in the future, you'll look at those businesses and you'll put a multiple on those businesses and you'll put a multiple on book.
At some point,
it'll be
yes.
some of the parts. We're a year away from that.
So you started really with the macro trading business. That's what you began doing a few years ago.
Yep.
Right. Then you got into the private investment business. So those are very much live.
Right. Those are the 2 businesses that are robust right now.
And you're trying to build an advisory business?
We're building an advisory business. We've got the right team in place. We're hiring 1 or 2 more people. And, you know, that's 2 parts. We already were in this business of helping people with white papers and giving advice. We're really moving into the more proper banking business. We're working on a merger opportunity right now. We're working on in the long run.
As an agent, you're in
as
between.
An agent, in between. With an advisory fee, you know, hopefully we sign a engagement letter soon, and that will be a nice piece of business. Our real purpose in the long run will be to help raise capital for people in this system. The world, you know, the crypto revolution, this decentralized movement, won't fulfill its destiny with $300 billion of market cap, right? It's going to need lots of capital, and we want to be the credentializer who raises capital for the best projects.
What about the asset management business?
Asset management is doing great. We have $450 million under management. We have
including not external capital.
External capital. So we have a $325 million venture account that operates in and around the EOS ecosystem. So it was a specific mandate. We have a cash management account, and then we have our Bloomberg Galaxy Crypto Index Fund, which tracks the index that we set up with Bloomberg.
So, a year from now, how much will you have in AUM? What do you figure?
A lot. I hope a lot more than we have now.
Of course you hope, but I'm trying to get a sense of what the ramp looks like.
Listen. I think we're not going to raise another venture fund because we have venture on our own balance sheet and we have this EOS venture fund. I think the Bloomberg Galaxy Index is going to be one of those things where you're grinding in money and all of a sudden it hits an inflection, right? We are spending tons of time educating institutional investors about blockchain, about the space, and we're hoping that all that hard, elbow grease of education comes back, and when they start buying, this is a really good product for institutional investors. I laugh. I've got four sales guys. I call it the boiler room. They are on the phone. They are traveling all around the country and the globe, sitting with people and saying, hey, this is how it works. This is why you should invest. This is your first step in. And so, we raised more money this month than last month, and I have a feeling it's going to be a slow grind, and then it'll just pop. And so if it got to $500 million in a year, I'd be very excited.
That was Galaxy Digital founder and CEO Mike Novogratz speaking to Bloomberg's Eric Schatzker on BNN in Toronto. Bloomberg LP, the parent company of Bloomberg News, owns and operates the Bloomberg Galaxy Crypto Index in partnership with Galaxy Digital. Well, it is a sign that network equipment sellers are starting to gain business from the new cellular technology. Nokia has won a $3.5 billion agreement with T-Mobile to build fifth-generation mobile networks in the United States. T-Mobile has said its customers in New York, LA, Dallas, and Las Vegas will be the first to run 5G technology next year. Coming up, investors and analysts are betting against Tesla as it heads into earnings Wednesday. We'll take a look at just what might be bringing the company down. And Bloomberg Tech is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok, on Twitter. This is Bloomberg. Goldman Sachs issued a warning on Tesla ahead of its Wednesday second quarter results. Despite the electric car maker meeting its production goals, Goldman says customer enthusiasm may be waning. The reason? Order availability has increased as well as test drives. And they're not the only ones sounding the alarm. Take a listen to what Neuberger Berman Steve Eisman, who famously predicted the 2008 collapse of subprime mortgages, had to say on Bloomberg Television Friday.
Elon Musk is a very, very smart man, but there are a lot of smart people in this world, and being smart's not enough. You got to execute, and he's got execution problems. I mean, we'll see how his quarter goes, but his negative cash flow, as you said, he's building cars in a tent, and he's nowhere in autonomous driving, as far as I can tell, and big competition is coming in his space next year.
Joining me now to discuss from Seattle, Colin Rush, Managing Director and Senior Analyst at Oppenheimer. And with us in New York, we have Bloomberg Business Week's Max Chafkin, who's been covering Tesla's ups and downs. So, Max, first, lay it all out for us. The bulls and the bears, what people are saying right now.
Right. So the big thing that's going on is Elon Musk sort of pulled out all the stops at the end of last month and hit this big milestone, 5,000 cars per week, which is, really impressive. Tesla is, a mass manufacturer now, which was the goal. The question is, basically, how much money did it cost to do that? They did all these crazy things, including building this tent. So how bad is that going to affect Tesla's bottom line? And then how sustainable is this? Can they keep making these cars at this pace, or even speed the pace up, despite all of the crazy things that they did to get there?
So, Colin, which way do you lean? I mean, Bloomberg has a story out today that says the clouds are darkening over Tesla. Are they really?
We think short term, actually, the risk is probably to the upside here. What we're looking at on the quarter is really cash gross margins. And the bull case is predicated on the idea that they'll be able to make a lot of Model 3s and generate cash from that manufacturing. Now, the bear case has gotten a lot of steam, especially recently, given all the struggles that the company's had and all of the special one-time effort that they made to hit these production goals. So as we look at what they're going to be doing over the next couple of weeks, and specifically on Wednesday. Speaking to those cash gross margins, is any sort of good news is going to drive the stock higher. Now, over the long term, we have a significant amount of concern around sustainability, especially given the fact that the company's not willing to raise money here. We think the company would be well served to put some cash on the balance sheet, extend their runway, and get focused on execution rather than all of the press releases and noise that they've got in the public realm.
Max, is it looking for any sort of good news kind of a low bar?
Yeah, absolutely. And I mean, I'll just throw in one other thing that people are going to be looking at, which is the demeanor of Mr. Musk. In the last earnings call, he sort of snapped at some of the sort of more difficult questions from Wall Street analysts. So I think one good sign, and this is going to be a low bar, but if he is able to play it cool, if the call is sort of uneventful in terms of any outbursts, that'll probably be taken as a good sign as well.
Colin, Musk has had a lot of ups and downs. He's recently apologized for some of the things he said on Twitter. You are one of the analysts that he's insulting analysts across the board. How do you feel about Musk's behavior?
I think it's a difficult job to be the CEO of a public company. I think he needs to grow up and be able to handle the job.
Other CEOs don't behave that way.
Sure, they don't behave that way, but they're under a lot of pressure, and I'll say that I don't think it's respectful, and I don't think it's right, but it is what it is, and I have a job to do, and I'll do my job.
Max, talk to us about some of the other things that Elon Musk has been working on. And to Steve Eisman's point, it's that Musk is a visionary, but he has an execution problem. Now Tesla is working on direct delivery from the factory to the home. All of these things sound great, but isn't it just about getting as many cars out as possible and making sure it doesn't hit the bottom line?
Yeah, I mean, it kind of depends on how you see this company. I mean, the sort of really optimistic case is that all of these new things that Elon Musk is doing, including something as small as, delivering cars directly from the factory, but as large as sort of new models or autonomous vehicles, or sort of reimagining the energy grid. That's all sort of future stuff. So if Elon is able to keep pulling these tricks out of his hat, pulling these rabbits out of his hat, then that looks really good. On the other hand, the other way of looking at this company is it's just a car company that's having trouble getting cars out the door, and that's bad if that's all you are. So that's kind of where the tension is.
Colin, final thoughts. You've got about 20 seconds.
We think there is a big vision here. We think the execution issues are weighing this company down, and they need to make some decisions about how focused they're going to get on this execution and whether they're going to make some changes in the management team to be able to fulfill that vision.
All right, we'll see if he lets you do your job. Oppenheimer's Colin Rusch and Bloomberg's Max Chafkin. Thank you both. Coming up, he's a big backer of Facebook, and despite its last quarter, Vaynerchuk Media CEO Gary Vaynerchuk is only buying more. That's next. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. Is it time to worry about Facebook? The social network second quarter results showed it may be running out of new users, and investors reacted swiftly, wiping $100 billion in market value off the stock. But one person who's not worried is investor Gary Vaynerchuk. Here's what he had to say when a Twitter user asked about Facebook's drop last week. I bought the stock today. That's my thoughts. We sat down with Gary Vaynerchuk for a wide-ranging interview that began with what else but Facebook.
I bought a couple $100,000 worth of shares. I bought some more this morning because I'm a long-term believer in the stock, and I don't think there's going to be a lot of moments over the next 3 to 4 years outside of macroeconomics that I'm going to be able to take advantage of it. I don't tend to buy a lot of publicly traded stocks. My original Facebook came pre-IPO, but when it got hit, when all the Cambridge Analytica stuff happened and Mark was on trial, I bought a ton. And then obviously off this missing numbers or news recently, I've been buying up a little bit more, mainly because I think in the next 4, 7, 9, 13, 26 years, it's a good buy.
So it's interesting that is a big bet. Roger McNamee, early Facebook investor, who I'm sure you know has been out there very publicly critical of Facebook, he compared Facebook to Philip Morris to me in terms of Facebook's negative impact on the world. What about concerns about fake news? What about online hate? What about concerns about our privacy?
I think there is a stunning non-conversation about taking on some sense of responsibility, meaning sure, but choosing CNN or Fox or MSNBC has as many dynamics as what you're seeing in your feed, and then more importantly, what you're choosing to consume as real. I mean, to me, the thought that Facebook is any different than Twitter or Instagram, which obviously they own, or websites or a million different ways we consume is kind of laughable and silly. I mean, Visa and Target and the American government itself has had breaches of information far more dramatic. And so, yeah, I mean, I understand the concept, but I think making a jump from Philip Morris, which systematically spent lobbying dollars and tried to pay off politicians for 4 to 5 decades to suppress information, is an awfully big jump by that person.
Okay, but what about profitability versus privacy? Will one always trump the other? And can we actually trust Facebook?
I mean, I have no problem trusting Facebook any more than I trust any other company on earth. Profitability and privacy is kind of funny to me. We choose to do convenience over profitability every day of the week and privacy. I mean, the way we pick privacy on a pedestal is almost non-existent in our actions. Every person watching this right now gives up privacy every day for convenience and speed. And so whether it's going to be Amazon or Google or Apple or Facebook or any of these companies that sit as a layer on top of the internet, we have shown through our actions over the last 30 years and continue to with the usage of Instagram and others. I love all the people protesting Facebook on Instagram. We prove as humans all the time how we think about privacy, which is we love to talk about it, but we don't fear it as much because the underlying issue is the amount of bad things that happen to the health and well-being of our family or having our money stolen is extremely far and few between.
What about the forces that may be bigger than us? The fact that Russia tried to hack our elections using Facebook and that there's evidence that they're doing it again to sow discord. Has Facebook done enough to prevent itself from being weaponized?
Facebook, I mean, look, Facebook, this network, Fox, CNN, Twitter, it's all the same game where I think about it from a macro, which is we make decisions. Facebook or the Russians didn't make us pull for Trump or Hillary. And so I think that the information that people are buying ads and running them in our streams is very interesting, because if you look at the execution of people that run political ads, the cost of penetrating somebody with a different opinion versus one that already reinforces your stance is where this starts getting far more interesting. I think this is one of the great examples in human time of us not interested in accountability. Facebook didn't make you a racist. You made yourself a racist.
So let's talk about Twitter, because you use Twitter a lot. We saw the same huge dip on the back of Twitter earnings, and it's very clear that Twitter is just not in a high growth state. They've hit a plateau.
Yep.
In fact, they actually lost users over the last quarter.
Yep.
The influence is there. The President of the United States is using it as his megaphone, but it's not the next Facebook.
Yeah, no, but it was never the next Facebook. And the truth is, Facebook is all-encompassing, right? With Instagram, and who knows what Mark and Cheryl and the team is up to on their next M&A or innovation. You got WhatsApp. Yes, it is not the next Facebook. I assume it's not priced on Wall Street in the same manner. I will say this: if you look very closely to MoonPie, which is a small a snack brand. If you look at what Wendy's is doing, I will say that the business world is starting to understand how to use Facebook to drive business. We're working with Kraft Heinz on Miracle Whip. It stuns me how much Twitter is the backbone of driving sales at Albertsons and Walmart. So I will say that maybe the width of attention on Twitter is not growing to a stock market's want and needs, but the depth of attention in the platform and the ways to maneuver in it and its ad product. I've been, over the last 3 to 4 years, quite critical and not excited about Twitter publicly, but I, no question, have seen over the last 6 to 12 months a resurgence different than, let's say, the Trump effect of just how much attention is in the platform. And when you have attention, I think you have the ultimate currency. You know, to me, it'll be interesting to see what they do with their OTT. I think they should play in that space. I think they were flirting with that a year or two ago. Again, you know, I don't know how earnings are done or how much the street values things, but I will say depth, maybe not width, is emerging on Twitter.
The top 5 companies by market cap are Facebook, Apple, Amazon, Google, Microsoft. In 2007, just before the financial crisis, one of them was a tech company, and that was Microsoft. Is the market putting too many eggs in the tech basket?
Yeah, I mean, look, honestly, and I want to be very fair for the audience, I think about things in such long term, like the thought of me understanding the short-term economics of 90-day terms and numbers that most of the viewers here play on, and the arbitrary nature and just the fact that we're playing financial engineering, not actually building businesses. In the macro, of course not. We're not going backwards. Tech companies will continue to gain momentum. Let me pull it out right here. This is where we actually live, not here. And so in the super long term, no. In the short term, I have no sense if the market has overpriced these companies based on what the numbers that they can hit over the next 90 days. But like, people aren't going to be watching ABC and NBC over Netflix, right? People are not going to be consuming newspapers over Facebook. Like, that is only going to, we're just starting in that world. Short-term economics and the way the street likes to play, that's up to all of you guys. But the danger in a 5, 10, 15-year macro, I don't see it, because, you know, the reality is we're only heading in one direction, which is technology doesn't care about our feelings or our short-term judgment or Wall Street. It just continues to advance, and humans are engaging deeper and deeper and deeper, and will continue to in perpetuity.
Part 1 of our conversation with VaynerMedia CEO Gary Vaynerchuk. We will get his thoughts on Apple's foray into original content and why he's all in on Jeff Bezos next. And later, we're not done with earnings just yet. Tuesday, Apple's slated to report its third quarter. We'll talk about what to expect from the iPhone maker next. This is Bloomberg. Apple's first foray into original content wasn't exactly a success, but a lack of love for Planet of the Apps hasn't deterred the company. The iPhone giant plans to spend more than $4 billion in that creative space by 2022. And even though Gary Vaynerchuk was part of that show, he doesn't think that failure will keep Apple from joining the likes of Netflix and Hulu as top players when it comes to streaming their own shows and movies. Take a listen.
I think the sheer amount of money that I'm hearing they're throwing at it makes me optimistic. You know, I try to spend a good amount of time in Hollywood and Silicon Valley and Madison Avenue. You get a real sense, and I think the sense, if you talk to any of your Hollywood friends, production and agents and things of that nature, is everybody understands that it's an Amazon, Apple, Netflix, Hulu, and who's the next OTT, Facebook kind of world, that the networks are in deep, deep trouble. And even the cable providers, and even with mergers, the sheer dollars that these internet companies are going to throw at content, the NFL rights, it's going to be an Amazon, Google, Facebook, Apple world in kind of fighting for that. And so, yeah, I would say yes. I mean, I think that programming, the IP, is what actually matters in the end. And when Apple, not if, has its Breaking Bad or Orange is the New Black or NFL, that it will suck people in because of the IP in the same way that so many more people watch Hulu and Amazon than I think a lot of people thought they would 24 months ago, predicated on just one hit.
You talk about, I know you say you're not an expert on short-term market dynamics, but we're all watching Apple and Amazon in this race to $1 trillion. Amazon sort of coming from behind. In the big picture, do you see more potential in one company or the other?
Oh, in a substantial way. I think the delta between Jeff Bezos and Tim Cook as a 2018 CEO is unbelievably substantial. And I would bet every day of the week on Amazon.
Why?
Because I think Jeff has just shown so much more ability to navigate the end consumer's attention, which I think is the ultimate value in society. I think that Tim is an incredible guy, and I like a lot of the things he as a human and the company is trying to push to stand for. But I don't know, he's been the CEO now, what, 7, 8 years? I'm not sure, you can help me with this, but I mean, what, earpods? Like, I've not seen Apple win in voice the way they should have with the lead they had with Siri. The HomePod's still not out there. We've not seen them win an original program. It's now been 24 to 36 months that cat's been out of the bag. There's been no hardware innovation outside the earpods that has any blip of anything, and all they've really done is slowly just advance things that have been in place prior. And so I just, at least the way I think about the world, I don't look at it, the numbers and the ways in the short term and maximizing profit every 90 days the way everybody who watches this does. In the long term, what it means for consumers, Amazon, through a magnitude of things, has done a far better job of mattering to the end consumer and continues to gain leverage.
You mentioned the networks are in trouble. Have to ask about CBS, which is currently deciding the fate of Les Moonves after these accusations from a New Yorker article about crossing a line with women. Should he stay or go?
Well, if he's guilty, he should go.
Even after such a long and successful track record?
Doing the wrong thing is always the wrong thing, Emily. Like, you're only as good as your last at bat or the truth, right? We now don't look at Christopher Columbus the same way we used to after we looked carefully in all the things he did. And so, of course, I mean, I'm very aware, and listen, I love winning in business too, and everybody who's watching does, but if you're a human being that's willing to look the other way for money, you're not a good human being.
So, Gary, you've launched a new media men's lifestyle brand focused on the intersection of entrepreneurship and pop culture. You say there's not going to be any walls. There are no walls between editorial and advertising. What's the vision here?
So 18 months ago, I bought PureWow.com. I have VaynerMedia, the holding company's VaynerX. VaynerMedia is the agency, Madison Avenue Mad Men. PureWow and 1:37 p.m. is the publishing side, the Condé, the Hearst side of things. To me, if you really look at what the BuzzFeeds and the Vices and the Refinery 29s did a half decade ago, is they kind of created Publishing 2.0, where they started to do creative work for clients instead of just buying commercials on TV networks or in magazines. The branded content world started to emerge, and you saw those crazy valuations for a lot of those companies. I think the continued evolution of making content and getting people to see it contextual, that brings the Procter & Gamble's and the Coca-Cola's value, is what's going to happen in publishing, and we continue to try to innovate on creating original videos and apps and event marketing, things to help clients sell beer and makeup and deodorant.
Okay, last question. How are all of these, dynamics that we're seeing in social media companies impacting your investment strategies? What is hot right now and what is not?
I mean, look, a couple ways to look at this. For me, this is just real life. Facebook and Amazon are the two stocks all in that I believe in a 5 to 10 year macro. As long as Mark and Jeff are running those companies, I'm blindly in belief of how they'll innovate around voice, AR, machine learning. They just are CEOs that are willing to hurt their short-term economics to do the long-term equity for having legacy over short-term profit. I think the most interesting thing for kind of this audience and your show and what I grew up with in the mid-2000s on Web 2.0 and social media is there room for a Musical.ly or a Snapchat? Where is this next social network? And are people scared to do it because they're scared to be a feature, and Instagram and Facebook, Twitter will copy it and slow its growth like we saw with Snapchat? I'm most fascinated, will there be another social network on mobile devices? My assumption is yes, but how? And then more importantly, my investment strategy is massively being affected by one core thing. I believe voice devices are the next iPhone, and the apps built on top of the Google Home, Amazon, Alexa, and Apple Pod are going to be the place where I come out of retirement and do early stage investing the way I did with Twitter, Facebook, and Tumblr.
Our conversation with VaynerMedia CEO Gary Vaynerchuk. Coming up, we wait on one last big tech company to report results. Will Apple overshadow the trends we've been seeing? We will discuss next. This is Bloomberg. UBS decided its wealth management offices in Manhattan needed a makeover. So the Swiss bank has hired WeWork, a trendy operator of shared offices. WeWork's redesign includes a juice bar, a meditation room, and a lot more greenery. Terms of the deal were not disclosed, but it is the biggest ever for WeWork's Powered by We design service. Well, we're not quite wrapped up with earnings. Coming up Tuesday, Apple. Apple will report its third quarter results, and investors will be looking for any insight into upcoming new iPhones and how the current flagship iPhone X is performing. Another topic investors are hoping execs touch on, the growing trade dispute between the U.S. and China. For more, we're joined by Bloomberg Tech's Mark Gurman, who covers all things Apple for us, of course. So, Mark, why is this particular quarter important?
It's very important, obviously, because Apple's the biggest company in the world. And to your point, it's not the most interesting one, right? It's not the holiday quarter. It's not the first full quarter of new iPhone sales. But it's the quarter where we find out sort of when the new iPhone is going to be announced. We're going to look at the fourth quarter guidance. We're going to see, is it much higher than expected? Is it lower than expected? If it's lower than expected, more closely to this quarter, we might say, maybe the new iPhones won't come out until October, November like it did last year. But if it's higher, that means we're going to get a few more additional weeks of iPhone sales, new iPhone sales next quarter. So we'd be looking towards some of the higher guidance for that.
Now, walk us through what the iPhone is doing. I mean, there's always concern about how the best model, the iPhone X at this point, is doing. But it also seems that people are now really buying into this idea of a family of iPhones, and they don't necessarily need to have the best one.
Right.
Quote unquote, the best one, the most recent one.
And we're going to learn a lot about that based on the ASP, the average sales price. So the ASP last year was $606. And so some analysts are projecting $690 this year, which would be obviously an almost $100 leap. The iPhone X, $1,000, which would mean the iPhone X is a very strong contributor to the iPhone mix. If it's lower than expected, that could mean, maybe Apple's selling more of the older phones, the 7s or the cheaper 8s. So we're going to get a really nice picture of that once we know the revenue and the ASP numbers.
And you're expecting them to reveal a bigger iPhone X in the September quarter.
That's exactly right. So in the September quarter, 3 new phones. They're all going to be sort of like the iPhone X. The one's going to look just like the iPhone X, same size, same whatever, faster processor, camera, et cetera, et cetera. There's also going to be a cheaper one that looks like that one, almost a little bit thicker bezels, but it's going to have Face ID. They might call it the iPhone 9 and will replace the iPhone 8. Then there's going to be a very high-end phone, which would probably be north of $1,000, the most expensive phone, probably the most expensive phone on the market, actually, with a giant screen, 6.5 inches. A lot of people in Asia are going to be interested in that model because that is a single device sort of ecosystem. So that's going to be a strong seller, both in the US and internationally.
So where is the long-term growth going to come from? Is it still going to be the iPhone, or is it going to be services or something else?
It sounds like it's not going to be the iPhone. Based on every analyst we've spoken to, they're expecting growth from between 0% to 5% on an annualized basis for the next 5 to 10 years, which is not necessarily a bad thing, unless the iPhone starts, dipping down and losing 10% of sales annually, then it's a bad thing. But if it's pretty stagnant, that's a good thing if they're adding an additional layer on top, whether that's services, augmented reality glasses, something in self-driving cars, something in television, that really is a new driver to year-over-year growth.
So what are analysts expecting in the fourth quarter?
For the fourth quarter, they're expecting guidance in the $50 billion range. They're expecting a few weeks, 2 to 3 weeks of iPhone sales in the September quarter, which would seem to indicate strong year-over-year growth. They're expecting 15 to 17% year-over-year growth for the quarter, making it the strongest third quarter for Apple since 2015. So overall, they're expecting it's going to be a pretty inline, pretty good quarter for Apple.
We've been following the Apple versus Amazon march to $1 trillion. I was just speaking with Gary Vaynerchuk, investor earlier, who's like, Tim Cook is good and all, but Jeff Bezos is awesome. Tim Cook's come up with what? AirPods and the Apple Watch, and look at everything Jeff Bezos is doing. What do you think of that assessment?
You know, that's an interesting question. Tim Cook has definitely steered the ship in the right direction. He hasn't taken it off course. I think if you're anyone, not necessarily only Tim Cook, succeeding Steve Jobs, who's known as perhaps the greatest inventor of the last 100, 200 years, since the guy who invented electricity, that's a very difficult act to follow. And I think it could have been very easy to ruin. I think, you know, just because they have so much cash in the bank doesn't mean it's necessarily easy to keep the company not only afloat, but take them into new areas, grow it. I mean, we're talking about extreme amounts of money that other companies aren't reporting. So from that perspective, it's pretty good. But I think what Gary is talking about, or 10, 20 years from now, where's the new innovation, the new types of categories going to come from? And we haven't exactly seen that from Apple to date, but we have from Amazon recently.
All right, Bloomberg Tech's Mark Gurman, you're going to be all over Apple earnings Tuesday. Thanks so much for weighing in. Well, internet platforms are set to face tough new content laws in Europe as Brussels cracks down on hate speech and terrorist messages. Bloomberg has learned that companies including Google, Twitter, and Facebook could face huge fines beginning in September if they fail to take down propaganda and hate speech. Germany has already passed laws that threaten social media sites with fines up to 50 million euros for not tackling terrorist content. And that does it for this edition of Bloomberg Technology. Stay tuned for full coverage of those Apple earnings Tuesday, followed by Tesla Wednesday. Thanks so much for watching. This is Bloomberg.